First things first, the taxes collected for the Social Security Administration are complicated. There are two distinct trust funds that have different rates. By the end of this video, you will have a complete picture of how the pieces work. This video covers only federal income tax. Colorado, Connecticut, Minnesota, Montana, and New Mexico have varying methods of taxing Social Security and are not represented here. If you are employed and your employer collects and remits tax payments on your behalf, the employer matches the 6.2% and the 1.45% that go to two trust funds. If you are self-employed, you pick up the entire 15.3% of your income minus expenses. This is where I tell you that I am not a tax professional and you should consult one. The H&R Block Tax Program and I do my taxes. The Old Age, Survivor, Disability Insurance, OASDI fund is the larger of the two. This is the one that the monthly payments come from. It gets the 12.4% from taxable compensation, wages. The 2.9% goes to the Hospital Insurance, HI fund, also known as Medicaid. Many people are confused about how Social Security benefits are taxed and whether they will be affected by changes in policy. This lack of clarity leaves many retirees unsure about their financial security. Social Security benefits are a vital source of income for millions of retirees, and any changes to the tax regulations can have a significant impact on their lives. There's a lot of misinformation circulating about how these benefits are taxed, and it's essential to separate fact from fiction. By understanding the current tax regulations and proposed changes, retirees can better plan their financial future. Retirement benefits are based on your earnings history. Go to SSA.gov to learn how the amount of payments is determined. The $1,875 monthly payment per person used here is an example that is within the range of eligibility.
In this example, John and Mary want to plan their upcoming year using the worksheet. They take their monthly Social Security retirement checks and multiply them by 12. Then divide that in half. Lines 3 and 4 will be zeros. Line 5 is the sum of 2, 3, and 4. Line 6 is a 0. Line 7 asks, is the amount on line 6 less than the amount of line 5? The answer is yes. Subtract line 6 from line 5. The couple is married filing jointly, so they enter $32,000 for line 8. Is the amount of line 8 less than the amount on line 7? The answer is no. Notice that the difference between line 7 and line 8 is $9,500. That is the amount of taxable income that John and Mary can have without having to pay any penalty on their Social Security.
Cynthia, a single filer, is 68 years old. She receives $22,500 in retirement benefits. However, $1,875 a month is not enough to cover her expenses. Cynthia has a side business that has a profit of $20,000 in 2024. This income subjects $3,125 of her benefits to taxation. Added to her $20,000 taxable income comes to $23,125. Her standard over 65 for 2023 deduction is $15,700, leaving her a taxable income of $7,425. In addition to the $743 income tax, Cynthia pays $3,060 or 15.3% in self-employment tax that is sent to the Social Security Administration. When the legislation was enacted in 1983, it was estimated that about 10% of the retired population would be refunding a portion of their benefits. Today, that number has grown to about 50% of beneficiaries. So, what has to happen for President-elect Trump to keep the promise of no tax on Social Security retirement payments? Whatever it is, it must get passed through Congress. Just not reporting the payments as income will have some serious opposition. One major fact may be the solution. The median family income for 1983, according to the Census Bureau, was $24,580 in 1983. 40 years later, it is $80,610 for a 328% increase. This chart shows how those original limits would look today. Just over a 320% increase by permanently indexing the thresholds to inflation. There would be no need to change this tax structure again for over 90% of beneficiaries. Simply indexing the thresholds to inflation would accomplish the desired change for the vast majority of recipients. The tax-the-rich crowd gets a win as the wealthiest retirees would continue to repay the funds. By eliminating taxes on Social Security benefits, Trump's policy aims to put more money back in the pockets of retirees. This could be a welcome relief for many retirees who are struggling to make ends meet. However, it's crucial to consider the long-term implications of this policy change and how it may affect the overall economy. The loss of revenue could lead to cutbacks in other government programs or increases in other taxes, which could offset the benefits of the policy change. Many retirees could be affected, and the reactions from both supporters and critics of the policy. According to recent studies, over 60% of retirees rely on Social Security benefits as their primary source of income. This means that any changes to the tax policy could have a significant impact on their financial security. Supporters of the policy argue that it's a much-needed relief for retirees, while critics argue that it's a short-sighted solution that could have negative long-term consequences. To sum up, Trump's no-tax policy on Social Security benefits could significantly impact many Americans, and understanding these changes is crucial for planning your financial future. It's essential to stay informed about the proposed changes and how they may affect your benefits. Your House and Senate representatives need to hear from you if you have a preference. If you have any questions, please leave them in the comments below. I hope that you found value in this presentation. Please like and subscribe. Thank you for watching. Y'all come back now, you hear?